when you come back later on in the show. In the meantime, let's bring in Ed Yardeni of Yardeni Research and Emily Roland of John Hancock Investment Management. It's great to have you both with us. Ed, I'll begin with you because your note caught my eye today. For somebody who's been so positive on the market, S&P not likely to regain what's been lost since July over the rest of the year. Still think a rally's possible, but between now and Thanksgiving, easier to see downside given the developments in the Middle East and jitteriness in the bond market. Explain.
Well, the Middle East situation is horrible, and it certainly has the potential to become a regional war. We've already seen the United States attack some facilities over in Syria and Iraq. And so it's not over by a long shot. And unlike previous crises like these, this one may last a while. So I think we are going to continue to have uncertainty with regards to how that plays out. Now, of course, if there is some disturbance to the flow of oil, the Saudis will probably produce more unless they get involved in some ways in this whole thing. But meanwhile, the jitteriness that we're continuing to see in the bond market over the supply, I think will continue to hang over the market. But I do think we'll have a year-end rally. And I was thinking 4,600 by year-end, which is where we were back in the summer. I think maybe we'll get to 4,400.
Well, I think a lot of people would take that. In terms of the thing I was talking to Mike Santoli about, biggest events of the week, Treasury, obviously, on Wednesday, Fed, Apple, jobs. Which one carries the day to you?
Well, I think the market is going to be focusing on the Treasury refunding announcement, how much will be in the various kind of securities. That's what the bond market is concerned about. And these days, the stock market has to be concerned about what the bond market's concerned about. So that's where we are at this point. I think in terms of the Fed policy making, Powell is likely to say on Wednesday that remain fairly hawkish, which is, I mean, it was only October 19th that he was interviewed and presented a fairly hawkish outlook on interest rates, higher for longer. But we've known this for a while, so I don't know that the press conference is going to matter that much.
Yeah, Emily, I mean, we need a lot of things to go right, I think it's fair to say. Maybe this announcement that Steve brought us at the very top of our program is step one. No great surprises. Stocks near the highs of the day, as I suggested. You get the beginning of the Fed meeting and then some key events, Apple and jobs. Are you sanguine on the markets between now and the end of the year, or more cautious?
Yeah, I think markets, frankly, could continue to chop around here as we approach the end of the year. You know, on one hand, we're just really not seeing the type of liquidity event that we would normally see in the face of this much Fed tightening in such a short amount of time. But on the other hand, it's hard to identify a catalyst for the sort of explosive earnings growth that we've seen over the last couple of years. So I think that there's support there for higher quality areas of the market. I think as long as the labor market dynamics remain okay, as long as the consumer continues to spend, as long as earnings are decent, I think markets could continue to see some support here. But again, I think it's tough to imagine an environment where you're going to see a lot of multiple expansion here, especially given the fact that 12% earnings growth is baked into the equation for the S&P 500 next year, which I think is overly optimistic given where we are in the economic cycle.
But, you know, Emily, it's interesting. You say earnings have been decent. That maybe the difference maker this earnings period versus before, good earnings reports haven't exactly been rewarded this time like they have in the past. Does Apple help change that this week?
Yeah, I mean, potentially, and we've seen a lot of divergence across the earnings results for the Magnificent Seven here, you know, and I think it's an interesting point. We're seeing a 77% beat rate, which is solid. And on average, companies are surprising by 7.7%, but that's just not being rewarded. In fact, we're seeing stock prices on average falling around earnings reports. And I think, you know, the market is potentially sniffing out the fact that earnings estimates are overly optimistic. You look at the fourth quarter and estimates are being trimmed. They had been 8%. Now analysts are looking for 5%. And I think that's one reason that you've seen such concentration in terms of market performance. I think, you know, tech, we got a lot out of tech this year. We saw a massive rally to start the year in technology companies. So perhaps they sort of end up chopping around. Maybe we don't get a ton from them over the next couple of months as the year concludes. But on a relative basis, we prefer owning tech. It's higher quality, great balance sheets, good profitability over more cyclical parts of the market or unprofitable companies. That's where we would avoid chasing returns there.
Ed, is the tech trade intact or is it troubled?
I don't think it's troubled. I think it's an opportunity, quite honestly. By the way, on your question of what's the most important event this week, it may actually turn out to be on Thursday when we have productivity reported for the third quarter. We had a very strong productivity number in the second quarter. With the strength of real GDP, I think we could have another one in the third quarter. And I think we may very well be starting to see a resumption of the productivity growth boom that I think is ahead of us. And that can only happen if companies use a lot of technology to solve one of their biggest problems right now, which is a shortage of skilled workers.
All right. Well, both of you point out the cross currents that we have to navigate this week. It's going to be a busy and an interesting one, and we're starting off with a bang, at least on this Monday. Thank you so much. We'll talk to you both soon. Ed Yardeni, Emily Roland.